asking you to pick between 50 and 75, so I won't have to ask you that. Thank you for your last paragraph. But I want to talk a little bit about wages and inflation. So, as you said, wages are rising faster than is consistent with a 2% inflation rate, assuming reasonable productivity. You said in November that wages are not the principal cause of prices going up. But for many workers, real wages have been falling lately. So I wonder, isn't there room for wages to rise a bit faster so workers can make up lost ground? And what level of wage increases do you think is consistent with a 2% inflation target?
Okay, so I guess I would start by saying that the inflation that we saw at the beginning of this episode back in March of 21 was not really related to wages at all. It was related to tightness in goods markets, largely due to supply chain issues. Over time, though, inflation has now spread broadly through the economy. And while I would still say that the inflation we're seeing now is not principally related to wages, we think that wage increases are probably going to be a very important part of the story going forward, particularly as it relates to that third category of core services ex housing. So we think it is an important thing going forward. And ultimately, in the service sector in particular, where wages and benefits are by far the largest cost, wages need to go up. And of course, we want wages to go up. We want wages to go up strongly, but they've got to go up at a level that is consistent with 2% inflation over time, making basic assumptions about productivity. So if you look at the principal wage measures that we look at, I would say that you're 1.5% or 2% above that with current wage increases. So particularly the employment compensation index and the average hourly earnings index. Look at those two. It's about 1.5% higher than what would be consistent, making various adjustments, including for productivity, from nominal wages. So, and as we look at the labor market today, including today's JOLTS data, what you see is a labor market that there's a real imbalance between supply and demand. There are 1.7 job openings for every unemployed worker, everyone looking for a job. The so-called jobs workers gap is about 4 million, meaning if you look at all of the available jobs, including people who are working, and then look at people who are in the labor force or looking for a job, there's a 4 million shortfall. So you're in that world, and we think that there's a job for moderating demand in there and getting the labor force back into balance.
You don't think that there's a possibility that we should have a period of catch-up of wage increases above the sustainable level, and that businesses with relatively fat profit margins can absorb some of that without passing it through?
So that's the question of the worker share of profits and that kind of thing is not really related to this. Right now, people's wages are being eaten up by inflation. So what you want to do is you want to have inflation stable and then have a very strong labor market where the biggest wage gains are going to the people at the bottom end of the spectrum. And we had that at the end of the very long expansion that ended with the pandemic. That's not what we have now. Now, for most workers, the increases they're getting in wages are being eaten up by inflation. That's actually not true at the bottom end, where wage increases are higher than inflation. And that's a good thing. But if you want to have sustainable, strong labor market, where real wages are going up right across the wage spectrum, especially for people at the lower end, you got to have price stability. And until we restore that, we can't get back to that place where we kind of were for the 2 years before the pandemic hit.
And did you take, when you looked at today's JOLTS data, which measures the vacancies and quit rates, did you find that encouraging?
More or less in line with expectations, but that's
going the right direction.
That's a good thing, right? Yeah. So I guess job openings came down by several 100,000 to where they are now, and yeah, that's a positive thing. As you know, the relationship between job openings and unemployment is a very fraught one, and job openings right now, compared to unemployment, are at near their all-time high levels. So it has been our view that there's a possibility that in this highly unusual situation in the labor market could come back into balance to some extent through a decline in job openings, and that there's been a typical relationship between increasing unemployment and declining job openings, but that our thinking has been, and many labor economists share this, that you could get a decline in job openings that wouldn't produce the same increase in, a smaller increase in unemployment than is typically the case looking back in history because of the very outsized level of job openings. And we've kind of seen that so far, but it's way too early to say that that'll work.
Traditionally, the Fed looked at the unemployment rate as a measure of labor market tightness, and we've seen recently that that may be misleading. Unemployment rate is still very low, and as you pointed out, job vacancies are starting to come down. But to the extent that the Fed still relies on a Phillips curve kind of relationship, going forward, is the natural rate of unemployment a useless concept? What measures will the Fed use to judge labor market slack as we look ahead to policy in the coming years?
So I think the way we think about it, of course, the standard way to think about it is it's the gap between the actual unemployment rate and the natural rate of unemployment that matters, right? And the issue really, it's not that that framework doesn't make sense, it does make sense. But the issue is that the natural rate of unemployment is very hard to identify with certainty, even in normal calm times. But when there's a violent disruption of the labor market, it can move very substantially. So, and that happened at the beginning of the pandemic. You had the labor market was very much disrupted, and we assumed that the natural rate had moved up, meaning that for any level of unemployment, the labor market is tighter. So we knew that. And I think what was different in this cycle was really that you had to look at things like job openings and quits and reservation wages and just wages overall to tell you that the natural rate of unemployment had really moved up quite a lot. But I don't think it's a problem with the framework, but it is a fact, though, that it's very hard to pin down where the natural rate of unemployment might be when there's this massive disruption in the labor market going on.
So do you think that the JOLTS data, the job vacancies per unemployed worker, that's going to be a lasting measure of labor market tightness for you at the Fed?
Yes, I think people will tend to look at it.
Well, when you tell them you're looking at it, they tend to look at it.
They'll look at it.
I've noticed that.
That's right. I think I would just say in this particular situation, we think it's important, and we're going to find out empirically whether that was true for the reasons I explained. We think that we can see a big decline in job openings and less than you would expect of an increase in unemployment. So this was a unique in so many different ways.
Right.
This series of events was different from one in particular is just that so much of the inflation was due to supply side constraints,
right,
which is not a feature of the U.S. economy for a long time.
Well, but Vice Chair Lael Brainerd said the other day in a speech that she raised the question of whether long-term changes of the economy, like labor supply, deglobalization, climate change, could reduce the elasticity of supply, and that this may be a problem going forward. Do you share that?
So this is a great set of questions that we've all been thinking about a lot, and Lael's speech was really terrific on that. Augustin Carstens has given a couple of speeches on the same topic, including one at Jackson Hole this year.
The head of the Bank for International Settlements.
Yes, exactly. The question is, does the new normal going to be unlike this normal that we've had where supply side disruptions and constraints were relatively, you could look through them. The lore has been for a long time that you don't need to worry about that, it'll sort itself out, a supply shock from oil prices or whatever. Are we going into a situation a little bit like the 70s where there will be ongoing repeat shocks, and which would tend to put more upward pressure on inflation over time? We don't really know. I mean, it's a great question. But the question, I guess the real question is, if that's true, what are the implications? We still have a 2% inflation target, and we still have to use our tools to achieve it and to keep inflation expectations anchored. But it's very hard to know. It's very hard to know the answers to these things. I mean, we tend to assume things will go back to the way they were, just naturally, but that doesn't seem to be happening so far.
Right. Now, you mentioned in your remarks that forecasts of inflation have, not only those at the Board of Governors, but in the private sector as well, have been lousy. Inflation has not behaved the way the forecaster said. So I wonder how you think about using forecasts of inflation and making policy. If you can't tell us, or if your staff can't tell you with some degree of confidence what inflation is going to be 6, 12, 18, 24 months out, how do you think about that in deciding when you make policy decisions?
So I'll say that it is very difficult to forecast inflation now, and one of the reasons is just that the situation is so different from the normal one. And as I mentioned, a lot of it is just that the difficulty is just these supply side constraints that we've had. We had no experience in forecasting that. It was, this was a case of first impression. So that was very difficult. Nonetheless, we do make forecasts. We'll continue to make forecasts. The way I tried to get around that in my remarks was to say, let's put the forecasts aside for a second and let's try to identify the macroeconomic conditions that we think we need to see that would put downward pressure on inflation. So that's a way to think about it. We'll continue to make forecasts, but we're going to have to be humble and skeptical about forecasts, I think, for some time. And that calls for a lot of risk management. And the other difficulty, of course, is that monetary policy works with long and variable lags, in particular inflation is at the end of that train. And so if you're waiting for actual evidence that inflation is coming down, it's very difficult not to over-tighten if that's all you're doing. So we have a risk management balance to strike, and we think that slowing down at this point is a good way to balance the risks of
slowing down on the pace of rate increase.
On the pace of rate hikes.
I see. But it's still a problem if you can't use today's inflation rate to set policy and you're not sure what tomorrow's inflation rate is. You're saying the inflation forecast will be secondary to the economic conditions that you think are likely to generate more or less inflation. Is that basically?
Well, first of all, I'm agreeing that it's a very difficult situation in which to forecast inflation, and really very few professional forecasters have gotten it right. So I think we'll look at various things. We'll look at our forecasts. We'll look at the actual data. We'll look at, I gave you the three pieces and the elements of those three pieces of core inflation that we're looking at. We will, look at these macroeconomic conditions. For example, we will try to identify a level of a stance of policy that's sufficiently restrictive to bring inflation down. We can't identify that with great precision and confidence, but we'll look at the changes in financial conditions and the effects that those financial condition changes are having on the real economy. We'll look at all of those things and make a judgment, and it'll have to be judgment as to what that is.
Well, when you think you've talked frequently about the need to have policy restrictive, and that often is used as the definition of restrictive is above some neutral rate of interest, the one that will prevail when all is calm. And you gave a speech at Jackson Hole a number of years ago pointing out how identifying all these things, the natural rate of unemployment, the natural rate of interest, the problem is that we don't know what they are. So how will you know when policy is restrictive? How do you think about what the neutral rate is under the current conditions of the economy?
The answer to that is that there isn't any one perfect summary statistic. So the way I think about it, and I think the way we generally think about it, is we make our policy changes and they affect financial conditions. Actually, it works the other way around. Financial conditions tighten in expectation now, different from what it used to be. So they tighten. And so we monitor the tightening of financial conditions. We look at the history of these financial conditions index, and we ask how tight are financial conditions. We also look at the effect that tighter financial conditions are having on the real economy, particularly now interest-sensitive spending, but also other things as conditions tighten. We also look. So, what are the financial conditions we look at? We'll look at the entire rate curve. If you think about risk-free, the Treasury rate curve, we'll look to see significantly positive real rates across the curve, and you have that. You can argue about the short end, but you've got to pick some sort of a forward-looking reading for inflation, and I think inflation compensation in the markets definitely reflects confidence in us bringing down inflation. So you've got real rates really across the whole yield curve. You also look, though, at credit spreads and what are private companies borrowing at, because most borrowing doesn't happen at the federal funds rate. It happens in many other places. We look at asset prices. We look at exchange rates, which are just another asset price. We look at all those things, and we try to make a judgment about whether put some weight on the real the real interest rate curve, some weight on the other aspects I talked about. I think you have to make a judgment at the end, though, that you're restrictive.
So an estimate of the neutral rate of interest didn't seem to be one of the big factors in that list you gave?
No, it's in there. It's in there in looking at the real rate curve. So you look at the real rate curve, you'd want real rates to be above what we estimate as the longer run neutral rate. The issue is, the longer run neutral rate is a rate at a time of full employment and 2% inflation and the economy in perfect equilibrium. That isn't where we are.
Yeah, I noticed. Can I turn to the balance sheet for a minute? I'm going to turn to questions from the audience in a minute. What criteria are you going to use to decide when to end the shrinking of the balance sheet? Is it the economy? Is it whether money markets are functioning well? Is it whether the Treasury is having trouble raising money? How do you decide when you've shrunk enough, when you should end the shrinking?
So I should refer you to a document that lays all this out in detail that I really should be reading to you, but I'll paraphrase it.
Thank you.
If I don't get it exactly right.
No one will pay attention if you don't get it exactly right. Don't worry about it.
Pretty much wing it.
Relax.
So we're in an ample reserves regime, and what that means is that changes in the reserve level will generally not affect the federal funds rate. So there's more than enough reserves in the system. So we're not close to reserve scarcity. So what we said is that we would allow reserves to decline until we're somewhat above the level that we think is consistent with an ample reserve, with scarcity.
Right.
And then for a while, what you do is you hold the balance sheet constant, and non-reserve liabilities grow while reserves shrink. So we sort of shrink gradually down to that. And then at a certain point, we're just going to call it. We're not looking to really go back into proving that they're scarce, because what happens is, and you saw this back a few years, the demand for reserves is not stable, and it can move up and down very substantially. So we want to stop at a place that's safe. Having a lot of reserves in the system is really a good thing. It's really a public benefit to have plenty of reserves, plenty of liquidity in the markets and in the banking system and the financial system generally. So that's how we would do it.
In the minutes of the last FOMC meeting, it said the staff had a forecast that it forecasts below potential growth, but not a recession. But then there was this interesting sentence where the staff said the possibility that the economy would enter a recession sometime over the next year is almost as likely as their baseline forecast. Is that how you look at it?
So I have resisted the temptation to handicap it.
Go on.
I think I'll continue to do that. But I get the way I think about it is I do continue to believe that there's a path to a soft or softish landing. I do believe that, and
the definition of a softish landing is what? Unemployment goes up a little, but we don't have a recession.
Yeah, unemployment goes up, but it's not a hard landing. It's not a severe recession. You can think of unemployment going up, but not really spiking as it does in some recessions. So that's how I think about it, and I think the path is pretty clear. The labor market conditions soften. We see inflation, and the goods inflation gets better, housing services inflation gets better, and the labor market softens but doesn't go into recession, and you see inflation start to come down. And I think that's very plausible. I don't want to be the handicapper on it, and of course our job is to try to achieve that, and I think it's still achievable. Although, if you look at the history, it's not a likely outcome, but I would just say this is a different set of circumstances.
Well, you said at the last press conference that you thought the path to that soft landing had narrowed. Has it continued to narrow, or has it widened, or I don't know if you can have a wider soft landing, but
I don't know that it's changed since this is what, 5-6 weeks ago. Yeah. I was asked the question, has it narrowed? Is it still possible, and has it narrowed? I said it's definitely still possible, and it has narrowed because if you look over the course of this year, nobody expected us to raise rates this much. No one expected inflation to be this strong and this persistent, and this, to have spread so broadly through the economy. And so to the extent we need to keep rates higher or keep them higher longer, that's going to narrow the path to a soft landing. On the other hand, if we get good inflation data and we get evidence that all the things that I talked about, if all those things start to swing the other way, then we could very much achieve this.
In August 2020, you announced a new framework for monetary policy, the Flexible Average Inflation Targeting Framework. And I wonder whether there's anything in that that you think we should be rethinking now in light of the recent experience?
So we said we would do another framework review in 5 years, and so that would be to bear fruit in 25 or 26. So that's what we're going to do. We're going to stick to that. I think we need to see this through a full cycle. We need to see the other side of inflation and what the economy looks like after this historic episode to really make good judgments about that. I will say, though, that aside from the framework itself, we implemented it through guidance of various kinds, and you know, we put in really strong guidance because there were a lot of doubters that we would ever achieve 2% inflation. If you remember, that was the main criticism. Little did we know. But one piece of guidance that we gave was, and I don't think this had anything to do with or much to do, let's say it that way. It didn't have much to do with all this inflation we're experiencing. But the one piece of guidance that we gave that I probably wouldn't do again was we said we wouldn't lift off until we saw both maximum employment and price stability. And I don't think I would do that again.
Because?
I think it limited it's the tail risk. You know, we tend as human beings to underestimate tail risk, and I think we didn't think it seemed so unlikely. If you remember, 25 years of low inflation,
right,
and many years after the pandemic, after the global financial crisis of inflation everywhere in the world, it's all disinflation. Just didn't seem likely, and yet here we are.
So it turns out that when you invite the chairman of the Federal Reserve to speak at Brookings, a lot of people email you questions. Most
Really?
of them are questions I've already asked or questions that were so poorly framed that I couldn't even understand the question. But somebody asked me this one, and so I want to give that person an opportunity to get an answer. What do you like to do in the morning before you start work?
Work. No, I'm a super early person, and I read a bunch of newspapers and drink my coffee in peace, and then that's what I do.
And now that you're chair, do you still ride your bike to the Fed?
Some. I ride down. Well, I won't tell you where I ride, but I do.
Yeah.
I ride.
The security guys thank you for that.
They're like, no. Yeah.
Okay, so here's the deal. We're going to take questions from the audience. You need to wait for a microphone to get to you because we have a lot of people online. You need to say who you are, and you need to remember that this is not an opportunity for you to make a speech or tell the Fed what it should do. It should be a question. It should be short, and questions end with a question mark. So come down here. Want somebody, Joe, and then Jonathan?
Thank you. Joe Beaulieu from Brevin Howard. So you've spoken both about risk management considerations and the inherent danger of inflation becoming entrenched. So I was wondering, how much do risk management considerations suggest a terminal rate higher than would normally be expected to achieve your policy goals?
So I think there are a number of dimensions, and it wouldn't necessarily one of them would be potentially higher rate, but more I would think. One risk management technique is to go slower, right? To go slower and feel your way a little bit to what we think is the right level. Another is to hold on longer at a high level, and not loosen policy too early. I don't want to over tighten. Certainly, my colleagues and I do not want to over tighten because I think that cutting rates is not something we want to do soon. So that's why we're slowing down and going to try to find our way to what that right level is. But theoretically, it's another dimension, but it's not. It wouldn't be my first choice.
Thanks. Jonathan?
Hi, thanks. Jonathan Pingle with UBS. So I had a question about the imbalance between labor supply and labor demand. One of the things that's a little obscured when we look at and discuss the labor force participation rate is there is a pronounced downward trend due to population aging. So when you think about realigning labor supply and labor demand, are FOMC officials hoping or expecting that participation really moves back up all the way to a pre-COVID peak? And related to that is, the follow-on question, how much of the realignment do you think needs to be done through restricting labor demand as opposed to the ability of supply to catch up?
So on labor force participation, I think it's useful to go back 10 years. And the forecast that mainstream labor economists had was that, and you're right, aging of the population leads to declining labor force participation. Notwithstanding that, labor force participation was in effect flat and a little bit up from 2013 to 2020, roughly. And that was because you had a strong, tight labor market. People were staying in the labor market longer than expected. That was really what it was. So our ability to predict is not perfect in this, except over long periods of time, you have an aging population, so you're probably going to have declining labor force participation. I don't think it's reasonable to expect that we get all the way back to where we were with labor force participation in 2020 at 63.7, I guess, population adjusted. I don't see that, but I wouldn't rule it out, and we're nowhere near that now. We're 1.5 points below that now. So the real question is, do we expect to see big chunks of labor force participation? I got to say, this year we've seen, in the aggregate, not much, and it's been very disappointing and a little bit surprising. So that's part of the story. The other part, as I mentioned, is population. Is that the labor force, a big part of the shortfall in labor force is actually population as well as participation.
So given population trends, given that there's still some workers are clearly anxious about going to work during COVID, and given that immigration is well below the levels that were projected before the pandemic, does most of the balancing have to come on the demand side?
Well, I think for now, we have to assume that. That's why I talked about, supply side policies on labor, but although they're not for us to recommend or to answer questions about.
Noted, please.
So yeah, the answer is yeah. I mean, that's what I kind of said that in my speech. We have to do what it takes to restore balance in the labor market to get back to 2% inflation. And that's what we're doing. Really just by slowing job growth rather than putting people out of work.
Joe Gagnon.
Thank you. Joe Gagnon, Peterson Institute. Chair Powell, back in 2018, you gave a speech questioning the role of the so-called star variables that the Fed uses to navigate. And there was this possibility raised that maybe unemployment could fall well below what the staff thought the natural rate U star was, then without causing inflation. But then COVID came and turned everything around. And as you just said, one interpretation of COVID is that U star went way up and we were on the wrong side of it, which is inflationary. My question is, going forward, do you think it's likely that things could reverse as the dust settles from COVID and we could end up back in that world where maybe we're on the other side of U star, we don't know it, it's hard to tell? What lessons did you learn from that period that got forgotten because of COVID, perhaps?
Well, unemployment went below so what we write down and what the staff writes down is a longer run U star, longer run estimate of the natural rate of unemployment. I guess one thing I would say is that during the course of a long, relatively gradual, so we only have one experience, right, to generalize from, but what I learned from that experience was long, relatively slow, not super fast expansion. You really saw the natural rate of unemployment, the shorter term natural rate, come way down. We had 3.5% unemployment with really little sign. Wages were just getting up to that level of productivity and 2% inflation. So we could be back in that place. I think we could certainly be back in that place. But what we've seen, it's another N equals 1 situation with the pandemic. It's also unique. I would also point out, though, we did see the inflation we saw at the beginning. We did have natural rate of unemployment go up probably significantly. But the original inflation we saw was not to do with the Phillips curve, with the labor Phillips curve. It was not to do with that. It was to do with goods more.
So I think another way to frame Joe's question is, I think a lot of us thought that the lesson we learned when unemployment fell very far and we didn't get inflation, that maybe over time, before you were in charge, the Fed erred on the side of being too tight, that it was too worried about the unemployment rate falling. And I think the concern is that, will we fight the last war? And because of this experience, the Fed will be reluctant to experiment with a low rate of unemployment in the future.
I'd love to have that problem again. If we can get back to,
Okay, so you got like 3 years left in your term. Do you think you can pull this off in the next 3 years so we can run the N equals 2 experiment?
Absolutely, yeah.
Claudia Sam?
Claudia Sam Consulting. So the question I had is, we've had unexpectedly fast and large rate increases this year, and that has pushed up the dollar relative to basically any currency in the world. We've seen likely more financial market instabilities. So the Federal Reserve's dual mandate is for the United States, and yet are you worried that a severe global recession or financial market turmoil would come back to make it harder for us to achieve the U.S. dual mandate? Thanks.
So we do, of course, look at global developments. We have a domestic mandate, of course, as every central bank does. But in this world, global financial markets and the global economy really matter for us. So we monitor all that very carefully. We really think, and my colleagues and I really think, that the best thing we can do for ourselves and for the global economy is to get inflation under control as quickly as possible. We don't think the world's going to be a better place if we take our time and inflation becomes entrenched and then we have to go in later. The evidence is that the employment costs of bringing inflation down only rise with delay. So at the same time, we don't want to do any more than we have to do, but we feel like as a risk management matter, we needed to do what we did and feel like we're now in a place, again, as I said, where we can slow down and try to reach that ultimate level.
But how much do you worry about, I think what Claudia's question implies is, we do something with rates, other people are forced to do things with rates, and that ends up spilling back to us and makes it harder for you to do it. So you have to take that possibility into consideration.
So we absolutely believe that we take that into consideration. The model's explicitly taken into consideration. Of course, they're not perfect. No one would say we do it perfectly, but we have a very large global model that we use for the global economy, and it absolutely takes into account what's happening with the real economy and monetary tightening and currency and all those things. It won't be perfect, but we do that. And we also sort of understand generally that there's a lot of research and things, people are talking about this a lot right now, that maybe the whole is bigger than the sum of the parts when it comes to tightening. Maybe it is, maybe it isn't, but we're aware of the risk of that. But again, I come back to, look where we are. We've raised 375 basis points. Markets are working. I think we're now in a position where we're in a place where we really can get inflation under control, and unemployment's at 3.7%. So we haven't done, I don't regret getting to where we are, and I think broadly the world will be better off if we can get this over quickly.
Thanks. Julia?